The Fed has been warning us about the potential pain we'll see as a result of their rate hikes. Well, I think we're seeing some pain. We see mortgage interest rates at a 20-year high, and we also see purchase application volume at a 25-year low.
Johnny, that really hurts.
Good morning. A lot of important information to go over today, so let's get right into it. We got information from the MBA on mortgage application data. We go over this every week. What we saw this week was that last week, overall demand hit a 25-year low. Purchases fell by about 4% week over week and are now down 38% year over year. Part of the influence on this, of course, is interest rates, and interest rates moved higher from 6.81% on average to 6.94% on average. This is a slightly lagging indicator, but gives us pretty good real-time information on where things stand with rates. That puts us at the highest interest rate mark in 20 years, according to this survey. Rates are now roughly 3.75% higher than this same time last year, so a significant difference, and this marks the 8th straight week of increases to the average interest rate. And another piece of data to take a look at when it comes to the overall economy, it's rare that both stocks and bonds consistently fall together and both end the year negatively. Actually, since World War II, this has only happened 3 separate times: 1969, 2018, and so far, 2022. If the year ended today, it would be the first time in history that both stocks and bonds were over 10% down on the year. And an interesting component of that, though, is looking at what's happened in previous years following this type of abnormal occurrence. We saw in both situations treasury yields improved and mortgage interest rates improved. So it'll be interesting to see if we see that same trend. Obviously, we want to keep an eye out for interest rates, which have been on a consistent move up. What point are we going to see interest rates come down? And they're cyclical. There likely will be a period in time when that occurs. So we want to keep an eye on some indications of when that's going to happen. Now, Jake, there's another piece of information that we want to keep a close eye on, and that is transaction volume and inventory levels in particular. So give us some information on what we're seeing when it comes to inventory and specifically new construction.
Yeah, thanks, Kyle. So we just got the data in for September, and in September, overall housing starts were down 8% month over month, which puts them down almost 8% year over year. Now, when we look at just single family starts, which are the most important, those were down 5% last month and down 19% year over year. So that is expected to contribute to a continued tight supply with less new homes being built. According to the National Association of Home Builders, they said that the higher rates have weakened their demand, and I mean, we all know this, but they also added that this will be the first year since 2011 where we will have a decline in single-family starts, meaning new construction single-family homes. Another really big component of what they said is that builder confidence has dropped pretty significantly. It's down from 46 to 38 from September to October. This is the lowest point since April of 2020. 50 on this scale is considered to be a neutral level, with anything above 50 signaling expansion and anything below 50 signaling contraction. With a current reading at 38, this signals a pessimistic outlook from current home builders.
Good stuff, Jake. Yeah, it's interesting to see what home builders are looking at and what they're expecting, because that's going to have a lot of influences on the market. It does appear that builders have learned some tough lessons from the 2006-2007 time period in which far too many houses were constructed relative to the level of demand. They are now clearly building a lot less, and this actually has a few different effects. This is going to reduce the amount of supply, and that lack of supply, of course, is going to negatively impact the number of transactions. But it also can have an influence on home value. Lower supply can support home values through simple economics of supply and demand. And you couple that with homeowners who currently have low interest rate mortgages. Many of them either purchased when rates were lower or refinanced to a lower interest rate. That gives them an incentive to stay put. So that could continue to keep inventory levels low going forward. Some important information to keep an eye on. Of course, we're looking to see changes coming in the real estate market and where things accurately stand as of today. So we'll continue to keep you posted. Keep up the hard work out there and tune in next week. We'll see you on the bottom line.